Others swing to the opposite assumption, that these benefits are only relevant if you're affluent enough to have a financial advisor and a stock portfolio. So if Social Security is your main source of income, you tune out as well. Both of those assumptions are completely mistaken, and I'm going to prove it point by point. For every item we cover, I'll tell you precisely which group benefits most, so nobody watching can genuinely claim this doesn't apply to their situation. What this channel does is take the portions of the tax code and benefit system that are written in dense, confusing language designed to be skipped over and break them down into clear, actionable steps you can actually take this week. Here's the single question I want you to keep in mind throughout this video. How many of these bills can you legally stop paying right now? And how much money have you already surrendered every year simply by not knowing? Keep a mental count as we move through each item. The majority of people who watch this video from beginning to end discover at least 3 that apply directly to them. Here's what we're covering. 5 bills you can legally eliminate, reduce, or permanently freeze. Then, a set of advanced strategies for anyone who has built home equity or maintained an investment account. Because for the right person, those moves outweigh everything else on this list combined. And please stay until the very end, because the final 2 items have never been covered together anywhere else on this channel. One of them is a Medicare trap that catches surviving spouses specifically, quietly draining money from their accounts every single month with 0 warning attached. Let's start with the one sitting in plain view inside the federal tax code itself. The first bill is your federal income tax, and more specifically, a brand new deduction that simply didn't exist until recently. Beginning with the 2025 tax year, which covers the return most of you already filed or will file next spring, there is a freshly created deduction built exclusively for Americans aged 65 and older. It's called the Senior Bonus Deduction, and it can be worth as much as $6,000 per eligible individual. If you're married and both of you are 65 or older, the combined value reaches $12,000. Here's why so many people miss it. This deduction doesn't replace anything you already receive. It adds on top. For 2026, the standard deduction is $16,100 for single filers and $32,200 for married couples filing jointly. Stacked on top of that is a long-standing additional provision giving every person aged 65 or older an extra $2,050 if single, or $1,650 per qualifying spouse if married, and now the new $6,000 senior bonus layers on top of both of those. When you total everything up for a married couple, where both partners are over 65, you get $32,200 plus $3,300 plus $12,000, a total deduction of $47,500 before a single medical bill or receipt even gets considered. A working couple under 65 receives only the base $32,200. That's a $15,300 difference built entirely on your age. For many retirees drawing Social Security and a small pension, this figure alone wipes out their federal tax bill entirely. I've also created a free step-by-step guide that walks through every item in this video, form by form, in plain, everyday language. Check the description below to grab your copy. This deduction does carry an income ceiling. It begins to shrink once your modified adjusted gross income surpasses $75,000 if you're single, or $150,000 if you're married, fading out completely at $175,000 single or $250,000 married. For the vast majority of retirees watching this right now, that phase out will never touch you. You receive the full amount. One critical detail: this deduction is temporary. Current law limits it to tax years 2025 through 2028 only. That means you must verify it's being applied correctly each year it's available, not just once. If your tax software requests your birth date, enter it accurately because that single entry triggers the deduction. If a preparer handles your return, ask them directly whether both the senior bonus deduction and the age 65 additional standard deduction were applied. Both, not just one of them. The second bill is your property tax. This is where some of the most significant hidden savings exist, because it's not one program, it's actually 3 separate programs that can be layered on top of each other. And most homeowners haven't filed for even one of them. The first layer is the homestead exemption, which is the foundation for everything else in this category. It strips a portion of your home's assessed value away before your county calculates what you owe. Texas removes $100,000 from the school tax portion. Florida removes $50,000. Every state is different, but nearly everywhere, The savings are real and meaningful, and in most states, this doesn't happen automatically. You file a simple one-page document with your county assessor, usually ahead of a spring deadline. Once filed in most states, it stays active as long as you own the property. The second layer is the senior or age 65 exemption, EWAU, an entirely separate filing that sits on top of the homestead. Texas homeowners 65 and older receive an additional $10,000 removed from the school tax portion. Florida's senior exemption can add another $50,000 on top of the homestead, effectively doubling the total benefit. This is where financially secure retirees mistakenly assume they're not eligible. They hear senior exemption and expect an income test. But in more than half the states offering this, age is the only requirement. Texas, Florida, Georgia, Tennessee, and several others never verify your income at all. The third layer, and the most valuable one, is the assessment freeze. Once you reach 65 and submit this application, your county permanently locks your home's taxable value at whatever it was that year. It doesn't matter how dramatically your neighborhood appreciates afterward. In Texas, the over 65 tax ceiling freezes your school district bill at the actual dollar amount from that filing year. Not just the assessed value, but the bill itself. Your property's market value could triple. Your tax bill stays flat. This benefit matters most to the retiree sitting in a fully paid-off home that's been gaining value for 20 years, because that's the exact person facing the sharpest increases if they never applied. And renters aren't excluded from this conversation either. Your landlord pays the property tax on your rental unit, and every increase gets passed directly into your rent. When property taxes freeze or fall across a community, rent pressure eases too. Take one action here: call your county assessor's office and ask 3 specific questions. Is the homestead exemption on file for my property? Is the senior exemption on file? Is the assessment freeze on file? If any of those 3 are missing, ask which form covers it and when the deadline falls. The third bill is the federal tax applied to your Social Security income. This area generates more confusion than almost any other retirement topic. Whether your benefit gets taxed and to what degree comes down to one number the IRS calls your provisional income, which is essentially your other income plus half of your Social Security payment. Single filers with provisional income under $25,000 owe nothing on their benefits. Married couples have a threshold of $32,000. Above those points, up to 50% and ultimately up to 85% of your benefit can become taxable. But even at the very top, at least 15% of your Social Security is always protected from federal tax. Here's a widespread mistake I've observed across every income level. When enrolling in Social Security, a form called the W-4V asks whether you'd like federal taxes withheld from each payment, typically 10%, 12%, or 22% as a precaution. Then tax season arrives, some of that money comes back as a refund, and it feels like a windfall. It isn't. It's an interest-free advance you gave the government all year long. If your senior bonus and age 65 deductions have lowered your real tax liability, you're almost certainly withholding too much. Submit a revised W-4V, compare it to your actual return, and reclaim that money going forward. Also worth checking, your state may not tax Social Security at all. As of 2026, 41 states plus Washington, D.C. apply zero state tax to Social Security benefits. Only a small number still do in any form: Connecticut, Minnesota, Rhode Island, Utah, and Vermont. West Virginia completed its full phase-out, so it no longer applies to 2026 returns. If you live in one of the remaining states, review the specific exemption rules. Most still shield lower and middle-income retirees, even where the tax technically remains on the books. Hold on to your count because the fourth bill tends to generate the biggest reaction once people see the actual figures. The fourth bill is your Medicare Part B premium. Pay close attention here because what most people think they know about this number is outdated. For 2026, the standard monthly Part B premium is $285, automatically deducted from your Social Security payment before a single dollar reaches your account. That's a jump from $185 in 2025 Dow, nearly a 10% increase in one calendar year. But here's the piece almost nobody ever gets told. A group of programs called Medicare Savings Programs exists specifically to address this. If your income falls within the qualifying range, your state covers that premium on your behalf, not partially, but completely. Every month going forward, 3 main tiers exist. The most comprehensive, QMB, pays your premium and eliminates most deductibles and copays. For 2026, QMB income limits sit around $1,350 monthly for individuals or $1,824 for couples. The next tier, SLMB, covers the premium alone, with limits near $1,616 for individuals and $2,184 for couples. A third tier, QY, extends to roughly $1,816 for individuals and $2,455 for couples. Asset limits are approximately $9,950 for individuals and $14,910 for couples federally, though several states ignore assets altogether and California sets considerably higher thresholds. These income limits are higher than nearly everyone expects, which is exactly why millions of eligible people never apply. While you're checking eligibility, ask about extra help, also known as the low-income subsidy, which reduces your Medicare Part D drug coverage costs, including premiums, deductibles, and copays. Many people who qualify for a Medicare savings program also qualify for extra help, and approval for one often triggers automatic enrollment in the other. Make one phone call to your state Medicaid office or local SHIP office, the State Health Insurance Assistance Program, and ask to be screened for both. That single call can return more than $2,000 annually to your household. One more Medicare item worth confirming, regardless of your income. Part A hospital coverage carries no premium if you or your spouse logged at least 10 years of payroll contributions. Most people have this, but any uncertainty about your work record makes it worth verifying. For higher income households, there's also IRMAA, an income-related surcharge attached to Part B and Part D premiums. What makes it unusual is that Medicare calculates it using your tax return from 2 years ago. If your income has dropped significantly since retirement, you could be paying a surcharge based on earnings that no longer exist. The correction is Form SSA 44. Retirement, spousal death, divorce, or a major income reduction each qualify as life-changing events. You file it, provide current income documentation, and Medicare recalculates. It takes under an hour, and almost nobody does it because almost nobody knows it's an option. The fifth bill is smaller individually, but still represents unnecessary monthly spending. The Federal Lifeline program removes up to $9.25 from your monthly phone or internet bill, rising to $34.25 on tribal lands, with many states adding further reductions on top. Separately, the LIHEAP program, Low-Income Home Energy Assistance Program, helps directly offset heating and cooling costs, typically providing $400 to $1,500 annually, depending on your location and circumstances. These are distinct programs applied for separately, but qualifying income for one very commonly qualifies for the other. Individually modest, but combined with the larger items, these savings shift your monthly budget in real and measurable ways. Before the bonus strategies, 2 universally applicable items that cost nothing to explore. If you're a surviving spouse and your partner paid into Social Security, you may be entitled to a survivor benefit drawn from their earnings history. Eligibility begins at age 60. You can claim the survivor benefit now while letting your own benefit grow to its maximum at 70, or collect yours now and transition to the survivor benefit later if it's higher. Social Security will pay whichever you apply for, but they will not advise you on which sequence produces more lifetime income. If no one has ever modeled both scenarios for you side by side, that conversation belongs at the top of your to-do list. Also, if your return is straightforward, Social Security, a pension, maybe an IRA withdrawal, there's no reason to pay hundreds of dollars for tax preparation. The TCE program, Tax Counseling for the Elderly, is an IRS-backed service for people 60 and older, delivered by trained, certified volunteers. ARP Tax Aid operates the largest network available nationwide with no membership required. Complex situations involving rentals, businesses, or complicated estates still warrant a professional, but a standard retirement return shouldn't cost you anything. Now for the bonus strategies aimed at people with accumulated assets. A home that's grown in value, a retirement account, or an investment portfolio, these next moves are built for you and they can exceed the value of everything covered so far. If you've occupied your home as a primary residence for at least 2 of the past 5 years, federal law allows you to exclude up to $250,000 in gain from tax as a single filer or $500,000 as a married couple. That's gain sale price minus original cost minus improvement expenses, not the total sale amount. A married couple who bought for $70,000 and now has a $400,000 home carries roughly $330,000 in gain. They can exclude the full amount. Federal tax owed, zero. Many retirees stay in homes that have become too large or costly simply because they fear a tax event that in most cases would never have occurred. Within that lower income window of early retirement, a Roth conversion deserves serious consideration. Traditional IRA and 401k funds have never faced taxation. Every withdrawal counts as ordinary income, and required withdrawals begin at 73. In the gap between retirement and those forced distributions, when your income is often at a multi-decade low, you can strategically convert portions of traditional retirement funds into a Roth IRA, paying tax at today's lower rate while securing completely tax-free, penalty-free growth from that point forward. If your current bracket is 12% and future required distributions would push you to 22%, acting now is straightforward math. The opportunity closes when income rises again. A related window exists for investment gains. In 2026, single filers with taxable income up to $49,450 and married couples up to $98,900 owe zero federal tax on long-term capital gains. Taxable income here is calculated after all applicable deductions. If you're between retirement and required withdrawals with genuinely modest income, that's the optimal moment to sell appreciated holdings without triggering federal tax, rather than waiting until distributions push you into a higher bracket. Those required distributions deserve their own mention because they surprise people who planned carefully. At age 73 or 75 for those born in 1960 or later, mandatory annual withdrawals from traditional IRAs and 401ks begin regardless of financial need. These count as ordinary income, can make more Social Security taxable, can activate IRMAA, and can elevate your bracket simultaneously. This phenomenon is sometimes called the RMD tax torpedo. For charitably minded retirees, the most effective countermeasure is the qualified charitable distribution. Starting at age 70 and a half, you can direct up to $111,000 annually from your IRA straight to a qualified charity. That amount satisfies your required withdrawal without ever appearing as taxable income. Since most retirees now take the standard deduction, this is frequently the only way charitable giving actually reduces your tax burden. The transfer must go directly from your IRA custodian to the charity. If the money touches your account first, the benefit is lost. Now for the two items I promised from the very beginning. The first is the widow's Medicare cliff, which ties directly to IRMAA. Medicare determines IRMAA using income and filing status from 2 years prior. Married couples are measured against joint thresholds, approximately double the single filer limits. When a spouse dies, the survivor's filing status changes to single beginning the following tax year. But Medicare is still pulling numbers from the old joint return. The result is a surviving spouse being evaluated against single filer thresholds using income that was generated by two people, producing a surcharge that was never applicable to them individually, arriving without any warning in the same year they experienced their loss. The solution is the SSA 44 form. The death of a spouse qualifies as a life-changing event, but almost no one realizes a second filing may be required specifically for the filing status change, separate from any income adjustment. If you or someone you know lost a spouse within the past 2 years, confirm whether Medicare updated the IRMAA calculation based on the new status. If the SSA 44 wasn't filed for the status change specifically, an inflated surcharge is almost certainly still being applied. Picture a couple with $210,000 in combined income the year before one partner passes. No IRMAA surcharge under the married threshold. The survivor's individual income going forward might be $95,000, under the single filer threshold too. But Medicare is still referencing the old joint filing, placing the survivor into a surcharge tier meant for someone earning far more, potentially $80 to $200 extra monthly on top of the $285 base premium, arriving precisely when household income collapsed. It self-corrects in 2 years, but that's 2 years of unnecessary overpayment that filing the SSA 44 immediately eliminates. The second item is the Social Security do-over. If you enrolled in Social Security within the past 12 months and now realize the timing was wrong or the amount is lower than expected, Form SSA 521 lets you withdraw your application entirely, effectively erasing it. You return every benefit payment received with no interest charged. Your benefit then resets and resumes growing at the standard rate for each month you wait to re-enroll. This option is available only once in your lifetime, so it demands careful consideration. But if you're still within that 12-month window and the number you locked in was the wrong one, this is the mechanism that lets you correct it cleanly rather than accepting a permanently reduced monthly payment. Let's put this all together. Every item on this list shares one common thread. The law already recognizes your eligibility. Your county won't apply a freeze you never requested. The IRS won't lower withholding because your deductions grew. Medicare won't reduce your premium because your income fell. Every one of these systems waits passively for you to initiate. Whether you're drawing a fixed Social Security check or managing a paid-off home alongside a portfolio, something on this list applies directly to your situation. Here's what to do this week in order. Call your county assessor and ask specifically about the homestead exemption, senior exemption, and assessment freeze. Call your state SHIP office and request screening for Medicare savings programs and extra help. When your tax return is finalized, confirm that both the senior bonus deduction and the age 65 additional standard deduction were applied and revisit your withholding amount. If you lost a spouse within the last 2 years, check whether Medicare recalculated IRMAA based on your updated filing status. And if you're within 12 months of a Social Security filing you regret, explore the SSA 521 before time runs out. This is general educational content and does not constitute personal legal, tax, or financial advice. Program rules, income limits, and exemptions vary by state and change regularly. Always verify your specific circumstances with your county office, state agency, or a licensed professional before taking action. If this helped you today, share it with one person over 65 in your life. Every item on this list is completely free to claim.